Now, the thing about the rally that we've seen in equity markets is a lot of strategists are finding that they've blown through their year-end targets. Many had targeted around 5,200, 5,300 for the S&P 500, which would give it a nice 10% gain for the year. Except we did that already in 3 months. Some are nudging their price targets higher. Our next guests say maybe 6,000 would be in the offing. Let's bring in Jim Worden, Chief Investment Officer at Wealth Consulting Group, and Michael Purves, Chief Executive Officer at Tallbacken Capital Advisors. 6,000, of course, would be a very nice round number, Jim, and would imply some more than 10% upside from here, 15% upside from current levels. What gives you that optimism that we could see that?
Yeah, thanks for having me, Amber. Good to be with you. I think a lot of this really goes back to this AI boom that we're seeing. A lot of growth there. I know people talk about the valuations, and I look at those too, but we're just seeing massive revenue growth. We're seeing massive amounts of spending and collaboration, and it's not just NVIDIA. It's a lot of the large tech companies. That could help. And then at the same time, if we do get our 3 cuts that the markets are kind of pricing in that we get, and we have small companies do better. The breadth that we're seeing, by the way, in the S&P 500 is fantastic. So 80% of the S&P 500 is above the 200-day moving average. So I believe this momentum can continue. It's not going to be without volatility, however. We still have 2 geopolitical events going on. We have an election this year. And so I think we can get there. That's on the optimistic side is 6,000. I think it's really going to be between 5,400 and 6,000.
Michael, do you think we could hit those levels, see that this year?
No, I absolutely agree with Jim. I think there is a very strong macro setup that really started after the December Fed meeting. I call it dual Goldilocks. It's basically the Fed pivoting into sub 4% unemployment. And they're not pivoting in a classic, let's give a whole bunch of rate cuts. But they are certainly gone from hiking into effectively an easing cycle. And it remains to be determined whether we get 0, 1, 2, 3, or maybe more. But even if it's 0, they're still entering an easing condition. Now, the dual Goldilocks is really a reference to the fact that Fed move is happening concurrently with a much stronger worker consumer here in the U.S., which is getting better real wages. The employment data continues to be robust. We, of course, are a consumer-driven economy, and that can't happen without people being employed. But you know, the Main Street and Wall Street are kind of lined up together here in a very powerful way, and it's not often that happens. So I'm very constructive, and I agree with Jim. I've actually been out there with a 6K is a very realistic upside case for the S&P 500.
And Jim, you mentioned a broadening out of the rally, which of course is seen as a bullish indicator. We've got 20 all-time highs for the S&P 500, 0 in the last 2 years for the Russell 2000. Do you think that with this broadening out, we're going to see it maybe start to catch some of the smaller caps?
Yeah, I think we will, Amber. We're already seeing roughly 60% of the Russell 2000 above their 200-day moving average. This number seems to be getting a little bit better. I do believe we're going to have kind of a trickle-down effect with the AI boom, which is really just this fast-moving train, really hard to slow down now. And I think there's going to be a lot of companies that are players within AI that catch on to that, as well as companies that say, hey, look, interest rates are coming down. My balance sheet's looking more attractive, and I'm going to use some of these tools to be more productive, to expand my margins.
What do you think, Mike? Do you think that the Russell could be due for a pickup here?
Yeah, like I do think that there's a lot of subsegments of the market will get what I call participation trophies here. But I think right now, my sort of framework for thinking about U.S. equities is that a lot of the PE contraction and expansion, a huge amount of PE volatility over the last 4 years. I think that volatility of valuation is kind of behind us, but what it really is about where is the earnings growth going to be, and and how, sort of probability adjusted, how likely is that earnings growth going to be. And I still think that the big tech, even though it's been overcooked, from an earnings growth point of view, ultimately will probably pave the way higher there. But that doesn't mean I don't like other sectors. I do. I mean, I'm very constructive on industrials. I've been on the industrials for some period of time. I like energy and things that are tied to the energy transition here. I think with respect to the Russell 2000 or the IWM, which is the ETF that it tracks, I just think for me it's a little bit of a hodgepodge of a lot of different things. It's included meme stocks over time. It's included some biotech stocks, which of course are a different beast there. So I think I think there's a lot of small caps that are going to do great across different sectors there. From a index or ETF basis, I guess I'm a little bit more biased towards looking at some of the sector ETFs that are not big tech as a way to play that, as opposed to, say, the IWM.
Outside of the Russell, I mean, there's no avoiding the dominance in tech. Jim, where should investors go just to protect possible downside? Because valuations are stretched. You did note that that's something you're thinking about. I think the S&P trades at a 33% premium to the 20-year forward PE ratio. So we're there. If we hit, an air pocket, is there an area of the market that you'd feel comfortable hiding in?
Yeah, it's a great question. So I tend to agree with Michael in the sense that there's a lot of sectors that are actually looking really attractive, that are looking interesting. We also like industrials. Healthcare has been looking better, and energy is showing some signs of life here. So for our clients, it's always about diversification and good risk-adjusted returns. We want this to be a smooth ride. We want to participate where there is momentum. But if we see that if there's certain areas of momentum that are fading, we certainly want to make sure that we have diversification in other areas that can provide a benefit. One area that within just bond markets that we're a little bit more concerned about is high yield spreads have just gotten tighter and tighter, and they're the tightest they've been really since the beginning of 2022, and so that gives us a little bit of caution. We're a little bit more exposed to duration than credit.
Michael, what about you? Where would you recommend that if you take a sliver of defense?
Well, one thing that I've been looking at, and I do a lot of work with derivatives and such, but I actually think for sort of basic market hedging, I've been advocating VIX calls there for a few different reasons, but I think I like those more than, say, S&P 500 puts. There within the equity complex, what is the least vulnerable? That tends to be kind of boring stocks that are just not participated as much here. But look, I think the big tech, the Magnificent Seven or Magnificent Four, whatever subset of that is, you do have to be careful with them, because even though their cash flows, Microsoft's and Apple's cash flows are pretty remarkable in terms of how enduring they are. If we do get a reason to be risk off, the stocks that have really climbed the most will be sold the fastest and most aggressively there. But I also think it's a time to also consider international equities as well. You're starting to, certainly Japan has been a great market to be in. Europe has been surprisingly good this year. There for other things. So I think investors and allocators can consider other equity markets that are just simply haven't had the spectacular performance the U.S. has.
Cough, cough, Canada. The TSX certainly has been left out of the dust. So we did make an all-time high so far this year. And many do look to us and say, you know, it's a cheap market with a high dividend yield. I think that's an interesting concept, Jim, to pick up on. It's been so much of USA all the way because of that tech exposure, and really its dominance not just over the past year, but over several. And going to Europe has, you know, worked in sort of fits and starts. But how do you think about now being the time to go international? That's for you, Jim.
Oh, that's for me. We like international. We think that there's a lot of improvements there. Technically, things are just looking incredible, with the exception of the UK. You almost have every country in the European Union that's breaking out. Japan is breaking out after a long 34-year drought. So we like that. We want to focus on quality. The focus here is really just going to be making sure that we're in good names, so that if there is a cyclical slowdown, we want to make sure that we have, you know, good cash flows, good valuation, just overall good diversification. So that's what we're looking at internationally. We're focusing on quality, as well as within the U.S.